Most people lose confidence when they open a fund fact sheet. Today, that ends. In the last lesson, you learned what index funds are and why they're such a powerful foundation for long-term investing. Now, we're going one step further because you could know what an index fund is, but if you can't read a fund fact sheet, you won't know what you're actually buying. A fact sheet is like a nutritional label for your investments. It tells you what's inside the fund, how much it costs, how well it tracks the market, how risky it is, and whether it genuinely matches your goal. By the end of this lesson, you'll confidently understand the key part of any index fund fact sheet. No jargon, no overwhelm. Let's begin. Every index fund and ETF comes with a fact sheet, a short document created by the fund provider. It summarizes everything you need to know before investing. Think of it as, here's what this fund does, what it costs, where it invests, and how it has performed. Now, let's break down the most important section using simple examples. Just a quick reminder, this lesson is for educational purposes only and does not constitute financial advice. Section 1. Fund objective and strategy. This is the first thing you should look for. It answers the question, what index is this fund trying to track? For example, tracks the FTSE Global All Cap Index, replicates the MSCI World Index, tracks the S&P 500 Index. Why does this matter? Not all global or world funds invest in the same markets. Some will exclude emerging markets. Some will exclude small companies. Some only include large companies. So, copy the index name and search it if you're unsure of what it includes. Here, you will see one of the following terms: physical full replication, which means it buys all companies in the index. Physical optimized or sampling, which means it buys most, but not all. Synthetic replication, which means it uses financial contracts instead of owning the underlying asset. Synthetic replication is commonly used and regulated, but it introduces additional complexity that beginners may prefer to avoid initially. What are the things you should look for? For beginners, physical replication is usually most transparent and straightforward. Section 2. Performance. You'll usually see charts showing 1 year performance, 3 year performance, 5 years performance, or since launch. This is not about predicting the future. It's about checking how closely the fund tracks its index. You want to see the fund's returns move almost identically to the benchmark. For example, index gives 10.2%, fund gives 10.10%. That's good tracking. If there are big gaps, you should ask, are the fees too high? Is the fund poorly managed? Is the replication method affecting the accuracy? Section 3. Fees and costs. This section is crucial because fees compound over time. Ongoing charge figure, OCF. This is the annual cost of holding the fund. For index funds, this is typically 0.05% to 0.30%. If you see something above 0.5%, ask yourself if it is justified. A lower fee means more of your money stays invested and compounds over time. Tracking difference. This is the actual difference between the index return and the fund's return. It reveals the true cost of the fund, sometimes more accurate than the headline fee. If a fund consistently underperforms its index more than expected, that's a flag. Some providers also publish tracking error, which measures how consistently the fund tracks the index over time. Next one is transaction costs. Some funds list additional small costs related to buying and selling the underlying companies. Not a major concern for beginners, but good to be aware of. Section 4, holdings and composition. This is where you find out what you're actually investing in. Top 10 holdings. You'll usually see something like Apple 4.1%, Microsoft 3%, Amazon 2.5%, Nvidia 2.2%, and so on. If a fund is global, you should expect large US tech companies near the top due to market dominance. Sector allocation. This tells you which industries dominate. Technologies, healthcare, financials, industrials, consumer goods. If you notice heavy concentration, for example, tech being 30 to 40%, check if you're comfortable with the level of risk. Geographic breakdown. You might think you're investing globally, but some world funds include no emerging markets. Others lean very heavily towards the US. Typical global breakdown might show US 50 to 65%, Japan 6%, UK 3 to 4%, Europe 15 to 20%, emerging markets 8 to 12%. If a fund is labeled all world but places 20% in the UK alone, that's a different strategy. Section 5, fund size and liquidity. For assets under management, you see figures like 2.5 billion, 12 billion. Large funds generally are more stable, have tighter trading spreads, are less likely to close. So beginners should usually favor established sizable funds. Liquidity. This matters more for ETFs. If a fund trades frequently, buying and selling is easier and pricing is more stable. Section 6. Income versus accumulation. You will see terms like INC or DIST, which means it pays dividend out as cash. ACC, which means it automatically reinvests dividends. If your goal is long-term growth, accumulation funds can simplify reinvesting. If you like seeing dividend land in your account, income fund work better. There is no right or wrong, just preference. Section 7, ESG and ethical considerations. Some funds include ESG screening, fossil fuel exclusion, sustainability ratings. If ethical investing is important to you, check this section. Section 8, provider reputation. Look for established names such as Vanguard, iShares or BlackRock, Fidelity, HSBC, Legal and General. Large reputable providers typically offer lower fees, stronger tracking, and robust fund structures. In summary, these are what you must know before buying any fund. Whenever you look at a fund fact sheet, focus on these essentials. Which index is being tracked? Is the replication method physical or synthetic? How closely does it track the benchmark? What is the OCF or fee? Where is the money actually invested? The countries, the sectors, the companies. Is it income or accumulation? Is the provider reputable? If you can answer these 7 questions, you understand the fund well enough to make an informed decision. In the next module, we'll start putting all of this knowledge together to build a real personalized investment portfolio. See you in the next one.